Traders, today we're going to be looking at the S&P 500. This is the front month S&P 500 futures, and I'm also going to be looking at an options trade that we're going to be putting on over the next 2 weeks. So from a fundamental perspective, just going over quick macro fundamentals and some simple market commentary, the Fed's balance sheet has continued to shrink, and it really did pull the market lower. It isn't shrinking a ginormous amount, so it really isn't pulling the market down into a big crash, but we're still in a situation where we need to watch out for that. Do valuations matter in this market? No, and valuations have not mattered for a long time. That's why normally people like to talk about things like the Wilshire 5000 to gross national product and indicators of like that try to measure value. Schiller PE ratios and such, but it's all irrelevant because when you have bloated monetary and bloated fiscal policy pushing up a market that has been pushing up a market for decades now. In the late 90s, the Fed cut rates, it caused the dot-com boom. Afterwards, Fed funds rates went down to 1%. It caused a real estate boom after that. Full-on monetary and fiscal policy causing what we currently have today. And this time, though, instead of ending in ruin, it's going to end in the risk being transferred from asset holders to, or at least equity and fixed income asset holders to dollar asset holders. But that risk is going to then be transferred. But essentially, over the last few decades, we've seen a situation, and it's become increasingly larger ever since the financial crisis, where the market has rallied, even though it's already overvalued, even though there's structural problems, simply because of what goes on with central banking. And so really, I don't pay too much attention to valuations because in this market, they really do not matter, especially in the US markets, where you have very aggressive monetary and fiscal policy. So what you'd rather look at is what's going on with the Fed's balance sheet. It has been contracting, but it's not contracting large enough for us to say that this market is going to crash. But if it does start contracting big time, then definitely we're going to start talking about that. But it isn't doing that yet. And on the fiscal side of things are pretty calm. They haven't said yet, though, that they're going to come out with a new stimulus or anything. But everything almost happens after the fact. Action is only taken after the fact. So coronavirus happened, and then many companies took action after the fact. Coronavirus happened, Congress tried to take action after the fact. Of course, it's not the right thing to do, but that's how things usually work, is that something bad happens, and then it's only after the fact, though, that they try to solve the problem. So that's really what's going on in global macro. The reason I'm not talking a lot right now about the fundamental side of things and the global macro and valuations or anything like that is because valuations really don't matter. It is largely a positioning and liquidity-driven rally that we've had so far. And I think it's going to continue to be that sort of a thing. And so really things like valuations don't play into that because valuations have been high for years and years now, yet it's never mattered. So I'm not paying too much attention right now to the fundamentals. Really what is going on with liquidity and positioning for me is key. On the technical front, I think we are going to stay range bound for a while. So we have this large supply zone up here. So up here we have a large supply zone, and every time the price tries to get up there, it spikes up, but then it comes down, spikes up, comes down, spikes up, comes down, spikes up, comes down, and eventually it falls lower. And this right here, for all of you who don't know, S&P 500 index, the daily chart SPX 500 USD on TradingView is essentially just the S&P 500 futures, the front month futures. And front month futures continuous. So it just rolls it over every single month. So right here, you see that there's a large amount of overnight spikes, overnight spikes, overnight spikes. We can look at the SPX cash actually to see what happened. And what we can see is that there's a large gap. Now gaps should generally be filled. What should happen when you have a gap? It should be filled. Because gaps are areas where price traded with very low volume, with very little resistance, and that price should easily be able to go above it or easily be able to go below it. And there should be a quick liquidation break that sends it through the gap. But what we saw was that price tried to come up, but couldn't break, couldn't break, couldn't break. Now we know that on the futures, which are traded overnight, the price spiked like this. And it tried to actually get up there, but then it failed and came right back down. But during the day sessions, we could not fill this gap right here. And so it's a key thing on the upside that what should happen is that gap should be filled. But when what should happen doesn't happen, so when gaps should be filled but are not filled, the opposite tends to happen and then the market rolls over. On the other hand, though, I'm going to go back to the futures chart now. On the other hand, we have a situation where we are facing some major support. So there's a supply zone down here, and I will put in a support line right here, and it's right at the 200-day moving average or so. And a supply zone is simply where you have a lot of limit orders lined up. And you might be able to see this on an intraday basis, sometimes looking at things like the order book. But really, you're able to see this on the chart right here because it bounces off, creates this quadruple bottom, or I guess in a way you can call it a double bottom because it bounced right here and it bounced right here. But where all these moving averages are, there are oftentimes limit orders right there. They oftentimes act as support. 200-day moving average is acting as support. And there is a major demand zone right there. And if I said supply zone earlier, I meant to say demand zone. It's where it creates demand. Supply zones are on the upside where the price cannot get above it. So that's what we have going on right there. What makes me even less bearish, though, is that we have a situation where, and it's harder to see this on a price chart. Seeing this on a price chart is a lot harder, but still possible. And you would need volume to be there. So let's look at something like SPY. And then we are going to add on volume. And this is a lot harder to see on these sorts of charts. You would need specialized, usually you're going to need a specialized volume profile chart. And what volume profile does, and it's harder to see on these sorts of charts, is really going to have to zoom in, try to look at the 1-minute time frames, and you have to look at it individually. If you have access to what we'd call a market profile or volume profile chart, then it's a lot easier. The thing is that most brokers and TradingView and such don't have access to that, and most retail traders do not use a market profile or volume profile analysis at all. And many institutions don't either. It's something that's used by very few people, and so generally most brokers don't offer it because there just isn't the demand for it. But what it essentially is, one of the things that it does is that you have a normal chart, and a normal chart might just have a line on it. And so a line chart doesn't tell you much. All it tells you is the closing price for whatever period you're looking at. So if we're looking at the 15-minute chart right here, it's going to tell us the closing price. So it gives you some information, but it doesn't give you a lot of information. Candlesticks take it to the next level because they're able to tell you what happened in that 15 minutes. What a volume profile chart does is takes that to the next level, and it's a type of chart, and it's fairly easy to learn. After you get the hang of it, it's fairly easy to read, but it's a type of chart where it's able to tell you what we call the point of control. The point of control is simply the price at which the highest volume traded. So right here, we see the time that the highest volume traded, and this is why it's harder on one of these charts. So right here, we can look at volume right here on the bottom, and we can see how much volume traded at this particular time. So we can see how much volume traded at a particular time, or we can say there's a fair amount of volume right here at this particular time, not a lot of volume right here. We can see the amount of volume that traded at a particular time, but not necessarily at a particular price. What a volume profile chart does, it lets you find the point of control, which would be the area where the largest amount of volume traded at a particular price, not a particular time. And so it takes things to the next level because you have everything that you have on this chart, but it adds more onto it. And so you can look at a daily volume profile chart, and you can actually see that there's this point of control, which is the volume relative to time, or excuse me, the volume relative to price instead of time. although you can actually see both. But you'll be able to see that there is essentially a point of control on Friday that was up here. And so the interesting thing about that is that all the volume that was traded for Wednesday, Thursday, and Friday, so this right here is Friday, this right here is Thursday, and this right here is Wednesday, the volume, the max volume at a certain price was actually quite high. For Wednesday, it was quite high. For Thursday, it was quite high, although that was a bullish day. But Friday, which was a bearish day, it was also quite high. So the point of control, the price at which the highest volume was traded, that stayed very high, and it did not migrate down. So the point at which you had the highest volume trading, even though the market went lower, the point at which you had the highest volume traded stayed high. And it stayed there throughout Wednesday, Thursday, Friday, and it did not migrate lower. It definitely did not migrate below the current price, lower down all the way to the bottom of the range. And so the price is usually attracted somewhat to the point of control. And if the point of control doesn't migrate down, then it's not really that bearish. It's just a small pullback. And so that was the big thing right there to watch out for, is that if you do have access to those sorts of charts, and if you don't, there's always market commentary online. Of course, I talk about it and such. But if you don't have access to those charts, we do talk about it occasionally, like I'm talking about it right now. It's not necessary to have access to those. It's easier when you have access to a market profile or volume profile chart to actually be able to see that than a price chart, where it's a lot harder to gauge different prices and squeezing into that altogether. But if you don't, there's plenty of channels. I know Shadow Trader is one of the channels that's fairly good. Every Saturday or Sunday, they release a video where they do talk about market profile. And so that's a pretty good one right there if you're interested in that. And occasionally I'll look at market profile, and if I see anything interesting, I might talk about it over here. But that was the thing right there, is that the highest volume traded stayed pretty high. And so it did not migrate lower, and that right there was something that was not very bearish. In fact, it showed that this might just be a small pullback, and it's going to go higher. The second thing also is that we saw a situation where the market came lower, but then it bounced. And then we saw a situation on Friday where the market came lower, and then it did end up lower, but it bounced intraday, and then really it didn't have any bearish follow through, just chopped sideways. And then it had bullish follow through instead today. So what does that tell us? Well, when you're using shorter term technical analysis, you're trying to find positioning in the markets. So you're trying to find out how mutual funds, hedge funds, pension funds, how the larger players, how are they positioned? And if you're a large hedge fund with $200 billion or $300 billion of assets under management, you are not going to be able to sell all at the open. You're going to have a larger time frame, and you're slowly going to have to sell, and you're going to actually move the price lower. The price is going to move from the top left of the chart to the bottom right of the chart. But on Wednesday and Friday, it wasn't that bearish because it didn't do that. And so normally what's going to happen is that if you're a large hedge fund and you want to sell tens of billions of dollars worth of a certain underlying in many other pension funds or mutual funds, long-only funds, many other funds, maybe a sovereign wealth fund, if they want to do that, what they're going to do is that they can't just go all in and put in a market order or even put in a limit order. They slowly have to iceberg into the market and do that throughout a whole entire day. And usually they have to do that at least for a day. If not, they might have to do that for a couple of days. Because if you're such a large player, you can't just exit all at once. Because it creates a liquidity issue and you get a bad fill and there's slippage, and it's not good for other participants either. So you slowly iceberg out of there, where you slowly get out of those long positions. Well, we didn't see that. We call those people other time frame traders. Longer term, usually 6 to 18 month traders are considered longer time other time frame traders. The longer time frame traders, or the other time frame traders as they're called, usually when they want to sell, the chart goes from the bottom or the top left to the bottom right. Yet the chart didn't exactly do that. It chopped sideways midday. It just sold off in the morning, and then it chopped sideways midday. And so that really tells us what's that there weren't other time frame traders in there who were looking to get out. That it was probably shorter term traders, short term swing traders, intraday traders, people on a shorter term time frame fixing their positioning. But really, what you're trying to do when you're trading like this, what you're trying to do is that you're trying to figure out what the other traders are doing. So if you don't, of course, know if every hedge fund is going to sell. But what you do know is that you can look for hints in intraday price action that large flows from large funds are getting out of the market. And so you'd have to start looking for very large flows in large funds to start getting out of the market. So if a large fund wants to sell, they will slowly sell from 9:30 in the morning until 4 in the afternoon, or they will hedge it out sometime the futures markets when it's liquid. So sometime before 9:30, it is still liquid, and it's liquid until a little after 4:15. Of course, closes, and after that, it is still liquid. But usually, that's when they're going to be selling, and they'll consistently sell throughout the whole entire day. They'll consistently hit the offer throughout the whole entire day and sell, and they will push the market lower from the top left to the bottom right on the chart. And that's simply not what happened. So the people who were selling, they were either panic sellers, or they were retail, shorter term intraday, or they were people who were short term swing traders. There was not any organized selling, not any organized selling from a fund. And that's generally how you actually look at it, is if you can look and actually see it how strong the selling was, and whether it was this quick panic selling or whether it was actually selling where you could actually draw a trend line and you could actually see the price slowly coming down, where it wasn't just a quick panic sell for 15 minutes and then the market bounced and then continued sideways for the rest of the day, or it wasn't just quick panic for an hour, where it was actually organized selling. And that's how funds generally do it. And you're able to see that in price action, and you're able to follow the big money. And so that's something right there that I was looking at with technical analysis. So really, that's all I have right now for technical analysis. When I see more, I will update you guys. Another thing that I was looking at was volatility analysis. And so I'm going to zoom out on the monthly chart. And volatility analysis, you can also call it quant analysis, whatever you want to call it. Most quantitative traders tend to trade volatility-related underlyings, because volatility is something that's very quantitative. It has math behind it. There's a mathematical formula that says volatility will mean revert, right? Overall, it's a very quantitative thing, whereas price tends to be more fundamental or technically run. But when I say quantitative, I mean there's a Black-Scholes model. There is a Brownian motion model. There is a jump diffusion model. These are mathematical models about options. And so right here, looking at the monthly chart, I think that we're actually going to start to go into a range. So I showed you that the price could not get above that level, but that the price seemed to have some support. I think longer term, though, that we head into a situation where we start to see volatility contraction. So I think that so far, over the last month, we've been in a situation where implied volatility has massively overstated realized volatility. That's the first thing. So you have that first thing right there, where implied is massively overstating realized. Also, we know volatility has to mean revert. So I'd much rather sell it than buy it right here. So what I'd want to do is that I do think we run into a situation like this, because we're in a range-bound market, where price for likely the next few months, the next few quarters, could just contract into a range. And that's not a problem for shorter-term traders, because shorter-term traders will actually be able to trade up and down throughout that, but longer-term traders will see that as a good opportunity, and also shorter-term traders will see that as a good opportunity to start shorting some volatility, where the volatility will contract. Because usually you see periods like this, go back over here, 2015, you'll see periods where the price essentially just stays flat. Look at that. The price was flat for 1, 2, 3, 4, 5, 6, 7, 8 months. Completely flat. And that happened right here too. There was some volatility, but it largely stayed flat. But then you saw an expansion out of that range and then back into a range. And so that's what tends to happen, is that volatility mean reverse, and it goes through these cycles where you see ranges that tend to happen where volatility tends to expand, it breaks out of range, something big happens, and then volatility contracts. Then it expands and it contracts. We are starting to go into that contraction phase in volatility. And I think that we could see a situation where for months or quarters, some people, and I'm not ready to say this, but some people think that for years, we will have a situation that for years on end, we will actually trade sideways. And it's something that could definitely happen. So if we look back over here, what we see is that on the monthly chart, price really got up to this level and price got down to this level right here. And what really happened throughout the whole entire time is that you went up, you came down, you went up, you came down, and then you went up right here until you got to all-time highs. But you essentially had a situation where you had, I guess we can say that that was almost a 20-year period where you had just sideways returns. And then right here, the market did eventually come higher, but then it came right back down, almost retested that. So you essentially had 2 decades, or some people could argue more than 2 decades, with a sideways market. That's 2000 2010 is known as a lost decade. We could see another situation like that. I don't think it's going to last years and years. Some people do. I'm not ready to say that yet, but I do think where we see a situation where for a few months at least we see some sideways chop and the volatility contracts, because on the S&P 500 we are at over 3,000. Yet if we actually look at the VIX, and we can look at the VIX currently, looking at the VIX, we're at 33. So the last time the S&P 500 was at 3,000, we had volatility over 3 times lower than it currently is. And right now we're also at 3,000 on the S&P 500, but volatility, or implied volatility, is over 3 times higher. So for the same price, or for the same price on the S&Ps, volatility is over 3 times higher. What does that tell us? That tells us that a lot more people are fearful, that a lot more people are buying the market, but they're buying protection while buying the market. So they're buying up the market, but then they'll buy some puts to protect themselves because they understand that this is a rally that's going on because of monetary and fiscal policy, but that this really isn't a rally that's happening because of true fundamentals. And so it's creating this market where when you have really low volatility and the market's grinding higher, you tend to see this complacency. Instead of creating this capitulation, which you usually don't see capitulation on the upside, but it is creating this capitulation on the upside, where people are actually worried, but they're still buying up the market because they want to make money and they understand that monetary and fiscal policy is pushing it higher, but at the same time, they're climbing a wall of worry. What I think is going to happen is before this market falls, people are going to go from capitulation into complacency, and so we have to see the VIX go down. And I think after the VIX goes down, then finally we could see the market start to come down. And so finally, when people start getting more and more complacent, we can start to see the market go lower. But we have not seen a complacency play out yet, and I think volatility contraction is expected. So that's something to be looking out for right there on a longer term time frame, is longer term volatility contraction. So playing along with those themes, what do we want to do for a option strategy? So I want to do a broken wing butterfly with a little bit more risk to the downside, since I think we're at the bottom end of the range. And so you can of course pause the video right here and look at the strike prices right here, which I would encourage you to do. And so I'm going to show you right here though the payoff diagram and where we're adding the risk on in this trade. But of course, pause the video right here and take a look at the strike prices and expirations if you want. So looking right here, The risk, the pain trade for this essentially is on the downside. And I don't think we see S&Ps get lower. I think that on a daily chart, it is at the bottom end of its range. The top end of its range would be around here. It's at the bottom end of this range right here, so I'm looking more so bullish. But I still think that we are in a range, which is why I chose a range-bound strategy. So essentially, if the price stays the same, you make max profit. If the price goes a little bit lower, you still make money. If the price goes as high as possible, you still end up making money. Just not as much as you would if the price stayed the same, and that goes along with our short volatility theme that we have going on. And on the downside right here, we have a situation where I'm putting the risk on the trade on the downside for this broken wing butterfly, because I feel that we stay inside a range and we do not get into a situation where we get down here. But that's a good trade going on for the next 2 weeks right there. Payoff diagram for this trade looks like this. And if you have any other questions, guys, just ask. And the overall theme going forward is short volatility, volatility contraction. Technicals are saying this thing's going to stay range bound, and volatility cycles, quantitative volatility cycles, are saying that this should mean revert and that the volatility should contract lower, and it should put the market into a range for the next few months, because we just traded into a range that would usually take 3 years to trade into. We just traded that in what was essentially just a few months. And so I think we see volatility contraction, and we see at least a couple of months, if not a couple of quarters, where we trade sideways. And so I think this is going to be a market where the active trader makes money, where the short premium people make money, where the active investor makes money, where the stock picking with things like long short equity portfolios makes money, because correlations are not going to be as tight in a sideways market as they are in a market that consistently has liquidation breaks that's either flying higher or flying lower. So overall, for all of those different things, I think this is a great two-sided market that we will have, and I think ultimately the active investor or the active trader ends up on top. And if you guys have not already watched my video, it is a bit of a long video on passive versus active investing and why I prefer active, but I talk about some of these things over there and go over back testing and all those good things right there. But I do think that the next few months, the next few quarters, and possibly even the next few years are going to be a situation where you do not want to be doing what we consider passive investing, or what many consider pie chart investing. You don't want to be doing any of those, where you have a little pie chart and you're saying, okay, 50% stocks, 10% muni bonds, 10% treasuries, everything else, and CDs, right? You don't want to be doing what we call pie chart investing, I believe, over at least the next couple of months, if not next couple of quarters. Some people are even predicting, though, the next couple of years, where this thing just chops sideways, because if you chop sideways, equities don't make anything. Your fixed income assets lose money because they lose money to inflation. Your trend following assets, they don't make anything. And so overall, unless it's short-term trend following, but longer-term trend following doesn't make anything. Long volatility doesn't make anything. You're just in a situation overall where if you're doing what we call passive investing or pie chart investing, it will not work out well, and you're just going to see, at best, sideways returns, if not grind lower returns, because of inflation and real returns and such. So again, active trading, I think the next couple of months are going to be the time for premium sellers. They're going to be a time for people who are ready for two-sided markets, people who are short volatility, people who are shorter-term traders who can actually trade within those ranges. And it's also going to be time for stock pickers who are using long-short equity portfolios and going long and going short on two sides of the market. And this generally tends to work well when correlations are low. If you have any questions, just go ahead and ask in the comment section below. On the last video, I went into the comments section. I had to manually check because I was not notified of any comments. I went to the comment section, and it told me that there were 4 comments, but I could only see 2 of the comments. So if you're someone who didn't get your comment answered, email me, and I will actually type in the email right here. email me right there. That is, I guess we'd call it for now, our official Gmail for our YouTube channel. And if you have any questions in caps or in all caps or in bold letters, put in YouTube question as a subject line and I'll get back to you. The problem is that YouTube's not notifying me of many questions that are coming in or comments that are coming in. And another problem is that I just can't see them. So if you have any questions that have gotten that are unanswered, either in this current video, last video, or any videos in the past that are unanswered, go on to the realalphaaction@gmail.com in the subject line, in all caps, bolded, put in YouTube question. And I'll get back to you right there. And that's the way that you can ensure that I actually get your email and that I'm able to answer all your questions. Because the YouTube comment section, I was saying earlier, go into the comment section, ask me if you have any questions. Problem is that I'm not able to get notified and I can't see all the comments for whatever reason that may be. So if you have any questions, email me right there. And you can also drop it both in the comment section and emailing me, as a comment section is a quicker way for me to get back. But you can do both of them if you want. So make sure you do those right there. If you guys like this sort of stuff, we're here pretty much, I would say, at least once a week. So at least once a week we're over here releasing videos and giving you trades on what we predict will happen in the future for the markets. So if you guys like this sort of stuff, definitely go ahead and subscribe. Click on the notification so every time we release a video, you get it right away and you're able to watch it and you're able to place a trade right away and get a good fill on the trade. And it really helps out if you guys can just put a nice comment below, whatever that may be. And if you guys can like this video, because it helps the YouTube comment section. Other than that, thank you for watching, everybody.